A video by Bravos Research about how the three most important peaks in stock market history all occurred under Republican presidents really helps to illustrate how the personification or face of capital tends to adapt to the changing needs of capital accumulation. It is the economic situation that tends to determine which party is in government more than anything else. Let's listen to what the video said.
The three most important peaks in stock market history all occurred under Republican presidents. Herbert Hoover, elected in 1928, right before the Great Depression. Richard Nixon, elected in 1973, right before a 50% drawdown in the US stock market. And George W. Bush, who presided in the lead up to the Great Financial Crisis in 2008. Today, Donald Trump has returned to the White House after one of the strongest stock market bull runs in recent financial history and is already implementing radically new policies that many believe could mark a similar pivot point in financial markets. So are Donald Trump's policies about to trigger another generational peak in stocks? Well, in the lead up to the 2008 financial crisis, many argue that George Bush's policies were instrumental to causing the financial crisis that followed. His administration aggressively promoted home ownership. He continued financial deregulation that had begun under Bill Clinton in an effort to allow more people to own homes. And at the same time, he implemented tax cuts in 2001 and 2003 in an effort to stimulate the economy after the 2001 slowdown. The combination of these three policies created the perfect conditions for the housing bubble to develop, eventually leading to the financial crisis. We could argue that some of these policies are not unlike some of Donald Trump's proposals to deregulate and reduce taxes. Now, these are pro-growth policies that can definitely benefit the economy. On the flip side, they can lead to excessive market speculation on financial assets like the stock and housing market, possibly leading to pain down the road. But it would be unfair to pin financial asset bubbles entirely on the incumbent administration. These are extremely complex phenomena with multiple factors at play, including investor psychology. A lot of it really comes down to bad luck for the president. Still, that doesn't explain why 18 recessions since 1900 have occurred under Republican presidents, compared to only 6 under Democrats. Average real GDP growth, so that's US economic growth, has been 1.2% lower under Republicans than Democrats since 1949. Job growth under Republican administrations has also been 1.4% lower, with the average unemployment rate 0.6% higher than with Democrats.
The first thing to mention is that George Bush took over from Bill Clinton and, as Bravos says, continued and intensified the same policy of deregulation in order to lower the costs of commodity production. Less money spent on regulation enables lower taxes and therefore higher profit rates. Such policies, along with others like privatization and anti-antitrust measures, are undertaken in response to build-ups of surplus capital that cannot be profitably reinvested, the inherent defect capitalism suffers from to a greater and greater degree, as we can see here from one form of surplus capital in US money market funds. Elections, of course, do not always coincide with the peak of a build-up in surplus capital, so the 2000 presidential election provides a great example of what capitalist crises tend to produce politically. Despite strong GDP growth under Clinton and promises of fiscal discipline from Al Gore, investors were growing more desperate for outlets for their surplus capital, with inflation in the year 2000 rising above 3% and the Federal Reserve interest rate above 6%, incentivizing banks to lend more to the Fed instead of the market. A decisive portion of capitalists and investors switched from Democrat to Republican in order to pursue deregulation and cuts to public spending, corporate tax, and interest rates more aggressively. The electoral system in the US is already weighted in favor of the Republicans, so in the event of a dead heat, whereby the Democrats had lost its clear majority, the ruling class seized the opportunity to install the most brutal of the two parties. Bush's deregulation and tax cuts lowered the cost of production and enabled an economic upturn but of course catalyzed the next bubble.
The same pattern holds true for the stock market. This chart shows us the average S&P 500 return in the months after an election. This blue line shows the average return after a Democrat is elected, and the red for Republicans. We can see there's a significant difference between the two. The average S&P 500 return is nearly 40% higher under Democrats than Republican presidents. So history does seem to suggest that the economy and markets have actually performed worse under Republicans than Democrats, which is exactly the opposite of what you would expect, given that the Republican Party is seen to be more favorable towards economic growth.
Exactly what you would expect is a Marxist analysis of capitalist crises, which arise inevitably through the underproduction of value in commodity production, resulting in surplus or overaccumulated capital that cannot be invested or reinvested profitably. As surplus capital rises, capitalists invest and spend less money and get more conservative and aggressive politically.
Again, a big factor of luck seems to be at play in these figures. You see, the economy goes through a natural cycle of expansion and contraction called the business cycle. And this business cycle is mainly influenced by the Federal Reserve, the US central bank's decisions. They adopt a loose monetary policy to stimulate the economy after a slowdown, and they adopt what's called restrictive policy when they try to cool the economy down. The Federal Reserve is completely independent from the White House, meaning theoretically they are not influenced by the incumbent political party.
It is, of course, true that bad luck comes into play because an election can take place 2 or 3 years before an economic crisis unfolds. Bravos says the main influence on the business cycle is the Federal Reserve, the US central bank, which adopts a loose monetary policy to stimulate the economy after a slowdown and adopts what's called restrictive policy when they try to cool the economy down. But Bravos's own explanation, which calls the business cycle a natural one, implies that the influence is the other way round. The Fed is influenced by the market slowdown to loosen its policy and vice versa. That market slowdown arises from capitalism's inherent flaws, which result in underproduced value and overaccumulated capital.
If we plot at which point in the business cycle Republican presidents were elected going back to 1949, we find that a lot of them were elected approaching the peak of the business cycle, and that includes Hoover, Nixon, and Bush. So their administrations were almost predestined to experience more economic downside during their mandate. And on the flip side, we see that Democratic presidents seem to have been elected during downturns or at the start of new recoveries, so benefiting from organic business cycle growth as the economy naturally expands. Now, we believe that Donald Trump has also been elected much closer to the end of the business cycle than the beginning. We can see that simply by looking at initial jobless claims in the United States. Currently, they are at very low levels. Now, although the timing varies greatly, a low number of initial jobless claims typically occurs in the few years leading up to a recession. So in other words, the end of the business cycle. This is what initial jobless claims look like at the very beginning of the business cycle, right after a recession. They're at elevated levels, and so there's plenty of room for the economy to improve. That's not where we are right now. Now, at the same time, we've had the yield curve that has been inverted over the last year, which is also something that typically happens near economic recessions.
The Democratic Party's existence enables a slightly different but still capitalist imperialist party to soak up popular discontent with the Republicans when the Republicans are in a crisis. The same is true in Britain, although to an even larger degree, given that Democrats in the US win more often than Labour do in the UK. Labour usually only ever gets into power when the Tories have self-imploded amid factional infighting. When do Republicans and Tories self-implode? Usually when they've had to deal with an economic breakdown and a trail of bankruptcies by imposing upon the public bouts of privatisation, centralisation, deregulation, public spending cuts, and income tax hikes. During that period, their popularity declines, but they also achieve what capital needs for accumulation to be revived: the sufficient devaluation of a sufficient amount of labour and capital, which makes employing labour and investing capital sufficiently profitable again. The Democrats therefore look like they're the best party for capital accumulation and economic growth, but they tend to inherit the conditions that enable that upturn. Laid down by the most brutal of the two parties, and voted in when capitalists are investing more and people are spending more, when everyone, especially capitalists, are therefore feeling a bit more generous.
Now, as you may have seen from our recent videos, we've actually extended our timeline for a recession to 2026, but that would still be a recession that occurs under Donald Trump's watch. Again, not necessarily because of his policies, but just because of where we are in the business cycle. By this point in the video, critics of Donald Trump may be disappointed to hear that economic performance is not necessarily dependent on the incumbent president. We do believe that there is one way that Donald Trump's policies could have a negative impact on the US economy, and that is through his use of tariffs that is comparable to Herbert Hoover's tariff policy at the start of the Great Depression. Herbert Hoover was elected during one of the strongest stock market bull runs in history. This was a time where corporate profits were at record highs, most financial assets were going up, but at the same time as that was happening, wealth inequalities in the US were reaching extremes, something that is not unlike what we are seeing today, with stocks making record highs at record valuations with record profit margins, but with the average American feeling extremely pessimistic about the future of the economy. So Hoover implemented a series of policies that were aimed to combat these wealth inequalities, and that included a radical new tariff policy that many believe was partially responsible for the big crash that followed. These were called the Smoot-Hawley tariffs. They hiked the average US tariff rate to around 20%, which led to a global trade war, grinding world trade to a halt.
Lo and behold, in economic conditions similar to today, a Republican president hiked tariffs, taxes on imports, to raise revenue, to fund income and corporate tax cuts, designed to boost investment and spending, and in turn, businesses' profits. Almost as if Trump's tariffs are not simply a political choice, but symptomatic of a declining economic system that has run out of other options.
Now, the average US tariff rate has steadily been going down since the Great Depression as world trade has opened up, and for now they still remain very low. But estimates suggest that a second trade war under Donald Trump could potentially take the average US tariff rate all the way back up to 17.7%. Our concern is that these higher tariffs will translate directly into lower corporate profit margins. If that happens, it would directly translate into lower stock market prices. For instance, during the Great Depression, corporate profit margins went from about 10 to 12% to 0%, which caused a 90% decline in US stock market indices. Of course, the Smoot-Hawley tariffs were definitely not the only contributing factor to this. High levels of debt, bank failures, deflation were all factors that contributed to that big crash. Still, it's generally accepted that the high tariff policy was a key contributing factor. Today, corporate profits are at all-time highs again, and it's not crazy to suggest that a large-scale global trade war could lead to a reversal of this tendency.
Corporate profits are at record highs overall, but for a smaller and smaller number of private companies. The number of US companies and banks has halved in the last 30 years.
Now, we also happen to believe that these higher corporate profits contribute to higher levels of inequality today, as shareholders are disproportionately rewarded relative to the working class. It's possible that Donald Trump's tariffs could reverse some of this, which could end up being a great thing for society, but it would likely come at the cost of financial pain as asset prices come down.
As Bravos itself concludes, all but explicitly, whatever policy Trump or any other US president for that matter pursues, a crisis is bound to follow. Capitalism and capital accumulation must break down, regardless of which party is in government. Not only is participating in capitalism's so-called democracy prohibitively expensive for the vast majority of people, but the capitalist class itself is not really in control either. The inhuman power of capital itself is.